December 2, 2001. Enron Corporation, the seventh largest company in America, files for bankruptcy. $63 billion in assets. 20,000 employees. A company that had been valued at $70 billion just months earlier is suddenly worthless. But here's the part that still shocks people. Enron didn't fail because of bad luck or market conditions. They failed because almost everything they reported for years was a lie. The profits were fake. The assets were fake. The company that Wall Street analysts called the most innovative in America was actually the most fraudulent. And they almost got away with it. The executives sold their stock for hundreds of millions while telling employees to keep buying. The accountants signed off on financial statements they knew were fraudulent. The lawyers structured deals they knew were designed to hide debt. The analysts kept recommending the stock even as the company was collapsing. And the regulators missed it all until it was too late. 20,000 people lost their jobs. Employees lost their retirement savings because Enron's 401k was full of company stock that became worthless. Shareholders lost billions. Arthur Andersen, one of the big five accounting firms, was destroyed. The scandal led to the Sarbanes-Oxley Act, the biggest change to financial regulation since the Great Depression. But what makes Enron so darkly fascinating is how simple the fraud actually was. They didn't use sophisticated financial engineering or complex algorithms. They just lied. They reported revenue that didn't exist. They hid debt in shell companies. They marked up assets to whatever value they wanted. And when auditors or analysts asked questions, they bullied them or bamboozled them with jargon until they stopped asking. The story of Enron isn't about complicated finance. It's about people who were so convinced of their own brilliance that they thought rules didn't apply to them. It's about a corporate culture that valued looking smart over being honest. It's about what happens when everyone is incentivized to keep a fraud going because they're all getting rich from it. And here's what should terrify you. Enron happened 20 years ago. We passed laws. We reformed accounting rules. We promised it would never happen again. But the same incentives exist today. The same pressure to meet earnings targets. The same temptation to hide problems. The same conflicts of interest between auditors and clients. We didn't fix the underlying problems. We just made them slightly harder to execute. Kenneth Lay was Enron's founder and chairman. He'd built the company from a regional natural gas pipeline operator into what appeared to be an energy trading powerhouse. Lay was politically connected, friends with both Bush presidents, a major Republican donor. He portrayed himself as a visionary transforming the energy industry. In reality, he was either complicit in the fraud or willfully blind to what was happening under his leadership. After conviction, he died of a heart attack before sentencing. Jeffrey Skilling was the mastermind behind Enron's transformation and its fraud. He'd come from McKinsey Consulting and brought with him an obsession with being the smartest person in the room. Skilling pushed Enron into energy trading and mark-to-market accounting. He created a culture where results were everything and how you achieved them didn't matter. Skilling was convicted of conspiracy, fraud, and insider trading. He served 12 years in prison. Andrew Fastow was Enron's chief financial officer and the architect of the accounting fraud. Fastow created hundreds of special-purpose entities, shell companies designed to hide Enron's debt and inflate its profits. He personally profited by tens of millions from these entities while they destroyed the company. Fastow eventually cooperated with prosecutors, served 6 years in prison, and now gives speeches about corporate ethics, which is ironic given that he embodied corporate fraud. Sharon Watkins was the Enron vice president who became a whistleblower. In August 2001, she wrote an anonymous letter to Ken Lay warning that Enron would implode in a wave of accounting scandals. She was right. But Lay ignored her warnings and actually had lawyers investigate whether they could fire her. Watkins became one of the key witnesses in the prosecutions and was later named one of Time magazine's Persons of the Year for whistleblowers. Arthur Andersen was Enron's accounting firm, responsible for auditing the financial statements. They knew about the questionable accounting. They knew about the special purpose entities. But they approved everything because Enron was paying them over $50 million a year in consulting and auditing fees. After Enron collapsed, Andersen was convicted of obstruction of justice for shredding documents. The firm was destroyed, going from 85,000 employees to essentially zero. The Enron traders were a special breed of aggressive, arrogant young men who made fortunes manipulating energy markets. They gamed California's deregulated electricity market, creating artificial shortages and price spikes. Recordings of these traders laughing about grandmothers in California who couldn't afford their electricity bills because of Enron's manipulation became symbols of corporate greed. To understand how Enron fooled everyone, you need to understand the era and the technology that enabled them. Enron started as a boring natural gas pipeline company after a merger in 1985. Ken Lay was CEO. 4 years, it was exactly what it sounded like, a company that owned pipelines and moved natural gas. Steady, regulated, profitable but boring. Then Jeffrey Skilling arrived. Skilling had a vision. Instead of just moving gas, Enron would trade it. They'd create markets in energy commodities the way Wall Street traded stocks and bonds. Enron would be an energy bank, making markets and taking spreads. It was innovative and potentially very profitable. The key was mark-to-market accounting. Normally, companies recognize revenue when they receive cash. But Skilling convinced the SEC to let Enron use mark-to-market for their trading business. This meant they could recognize the total expected profit from a contract immediately, even if the contract lasted 20 years and the cash wouldn't come in for decades. This accounting method is legitimate for trading operations. But it's also incredibly easy to manipulate. Because you're booking future expected profits today, you have to estimate what those profits will be. And estimates can be whatever you want them to be, especially for long-term contracts in markets that don't exist yet. Enron started booking massive profits from contracts that might never make money. They'd sign a 20-year energy contract, make optimistic assumptions about prices and costs, and boom, instant profit. The stock price soared. Wall Street loved it. But there was a problem. Enron was reporting huge profits but not generating much cash. The deals they were doing required capital. They needed to keep building the business. But they couldn't show too much debt or the credit rating agencies would downgrade them. And if they were downgraded, many of their trading contracts would unravel. So Andrew Fastow created a solution: special purpose entities. These were shell companies that existed on paper, owned by partnerships that Fastow controlled. Enron would sell assets to these entities, booking profits on the sales. The entities would borrow money to buy the assets, but the debt wouldn't appear on Enron's balance sheet because technically the entities were separate companies. It was fraud disguised as financial engineering. The entities existed solely to make Enron's financials look better than they were. And Fastow was personally profiting from them, which was an obvious conflict of interest. But Enron's board approved it. Arthur Andersen signed off on it. And Wall Street analysts kept recommending the stock. The corporate culture at Enron encouraged this behavior. They had a rank-and-yank system where employees were rated on a curve and the bottom 15% were fired every year. This created intense pressure to show results. Nobody wanted to be in the bottom 15%. So people did whatever it took to make their numbers, including making up numbers. Enron also paid enormous bonuses based on deals closed, not on whether the deals actually made money. Traders and executives were incentivized to do as many deals as possible, book as much revenue as possible, and worry about actual profitability never. For most of the 1990s, Enron's rise seemed unstoppable. The stock climbed year after year. Fortune magazine named them America's most innovative company 6 years in a row. Ken Lay and Jeff Skilling were business celebrities. Enron built a gleaming new headquarters in Houston. They expanded into broadband, water, and international markets. They were going to revolutionize every industry they touched. But by 2000, cracks were appearing. The broadband division, which Enron claimed would be a massive profit center, was failing. International projects were losing money. The California energy market, which Enron had been manipulating, was in crisis with rolling blackouts and skyrocketing prices. This would eventually lead to investigations. In 2000, Enron reported revenue of $100 billion and profits of $1 billion. The stock hit $90 per share. The market cap was $70 billion. But almost none of it was real. Behind the scenes, executives knew the company was in trouble. They'd been using increasingly aggressive accounting to hide losses. The special purpose entities were becoming harder to maintain. Some were starting to unwind, which would force Enron to recognize losses. Executives started selling their stock. Ken Lay sold shares worth tens of millions. Jeff Skilling sold over $60 million worth. Other executives followed. They were cashing out while telling employees and the public that Enron was stronger than ever. In February 2001, Fortune magazine published an article asking how exactly Enron made money. The journalist noted that Enron's financial statements were impossibly complex and didn't clearly explain the business model. This should have been a warning sign. But analysts dismissed it. Enron was innovative. You had to be smart to understand them. In August 2001, Jeff Skilling suddenly resigned as CEO. He claimed it was for personal reasons. In reality, he knew the fraud was about to be exposed and wanted to distance himself. Ken Lay took back the CEO role. That same month, Sharon Watkins sent her letter to Lay. She warned that the accounting for the special purpose entities was improper, that Enron would implode in a wave of accounting scandals. Lay had Enron's lawyers investigate whether they could fire her, but ultimately left her alone. He did nothing to address the accounting issues she raised. In October 2001, Enron announced a $618 million loss and a $1.2 billion reduction in shareholder equity. They were reversing some of the fraudulent accounting from the special purpose entities. The stock plunged. Analysts started asking hard questions. Enron's credit rating was downgraded. This triggered provisions in their trading contracts requiring them to post more collateral. They didn't have the collateral. Trading partners refused to do business with them. The entire energy trading operation seized up. In early November, Enron restated earnings going back to 1997, erasing nearly $600 million in reported profits. The company admitted the accounting for special purpose entities had been wrong. The stock collapsed to under $10. Dynegy, a rival energy company, agreed to buy Enron for about $8 billion. But as Dynegy did due diligence, they discovered the problems were even worse than disclosed. The debt was higher. The losses were bigger. The accounting was more fraudulent. On November 28, Dynegy walked away from the deal. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in American history. Thousands of employees lost their jobs. Many also lost their retirement savings because their 401k plans were heavily invested in Enron stock, and they'd been encouraged to buy more even as executives were selling. The criminal investigations began immediately. Arthur Andersen started shredding documents, trying to destroy evidence. This would lead to their conviction for obstruction of justice and the destruction of the firm. By 2004, Ken Lay and Jeff Skilling were indicted on multiple counts of fraud and conspiracy. Andrew Fastow had already pleaded guilty and agreed to cooperate. The trials happened in 2006. Skilling was convicted on 19 counts. Lay was convicted on 6 counts of fraud and conspiracy. Lay died in July 2006 before sentencing. Skilling was sentenced to 24 years, later reduced to 14. He was released in 2019. If you think Enron was a one-time disaster that couldn't happen again, you're not paying attention. The same dynamics that enabled Enron still exist today. Mark-to-market accounting is still used. It's legitimate for certain businesses. But it's still easy to manipulate. Companies can make optimistic assumptions about future profits and book revenue today. Auditors often accept these assumptions without rigorous challenge. Special purpose entities still exist. They're now called variable interest entities or structured finance vehicles. They're more regulated than before Enron, but companies still use them to move debt off balance sheets or structure complex transactions. The conflicts of interest between auditors and clients persist. Accounting firms still make money from consulting services to audit clients. This creates pressure to keep clients happy rather than provide tough independent oversight. Sarbanes-Oxley was supposed to fix this, but enforcement is uneven. We also keep seeing accounting frauds that use similar techniques to Enron. Wirecard, a German payments company, reported $2 billion in cash that didn't exist. Luckin Coffee, the Chinese Starbucks competitor, fabricated $300 million in sales. These companies fooled auditors, regulators, and investors using methods that would have been familiar to Enron executives. The corporate culture problems are worse. The pressure to meet earnings targets every quarter creates incentives to manipulate results. Executive compensation tied to stock prices encourages short-term thinking. Rank and yank systems still exist at some companies, creating the same toxic competition. We also see the same pattern of whistleblowers being ignored. Companies investigate whistleblowers instead of investigating the problems whistleblowers raise. Legal departments focus on protecting the company from liability rather than addressing ethical issues. The California energy crisis showed how deregulated markets can be manipulated. We've deregulated many other industries since then. Each creates new opportunities for gaming systems and exploiting loopholes. Most disturbingly, we see the same warning signs being dismissed. When journalists or analysts ask how a company makes money and can't get clear answers, that should be a red flag. But often these questions are dismissed. The company is innovative. It's complicated. You have to be smart to understand it. Those are the same excuses people made for Enron. Enron teaches us 3 lessons we keep refusing to learn. First, complexity is often a red flag, not a feature. If a company's business model is so complicated that nobody can explain how they make money, they might not be making money. Legitimate businesses can be explained clearly. Frauds hide behind complexity and jargon. Second, incentives determine behavior. Enron created incentives for fraud. Executives were paid based on stock prices, encouraging manipulation. Traders were paid for deals closed, not deals that made money. Accountants were paid by clients they were supposed to audit independently. The system was designed to produce fraud. Third, culture matters more than rules. Enron had compliance programs and ethics codes. They had policies and procedures. But the culture was rotten. When everyone from the CEO down believes rules don't apply to them, when arrogance and greed are celebrated, when questioning authority is punished, compliance programs are just window dressing. Here's what should keep you up at night. The people who ran Enron weren't dumb. They were some of the smartest people in business. They had degrees from top schools. They were advised by elite law firms and consultants. But they used their intelligence to rationalize fraud. Being smart doesn't make you ethical. And many of the conditions that enabled Enron still exist. We've made some improvements. Sarbanes-Oxley increased penalties and requirements. Auditor independence rules are stronger. But the fundamental incentives haven't changed. Companies still face pressure to meet targets. Executives still get rich from stock prices. Auditors still want to keep clients happy. The next Enron is probably being built right now. It might be in a different industry. It might use different techniques. But the pattern will be familiar. Complexity hiding fraud. Incentives encouraging manipulation. Warning signs being dismissed. And very smart people convincing themselves that their fraud is somehow different. If this video made you more skeptical of companies you don't understand, good. If it made you ask harder questions when businesses seem too good to be true, excellent. Skepticism is healthy. Complexity should be questioned. And when someone tells you that you're just not smart enough to understand their brilliant business model, remember Enron. Share this with anyone who needs a reminder that intelligence and ethics are not the same thing. Subscribe for more deep dives into corporate frauds and the patterns that repeat throughout history. Enron showed us that the smartest guys in the room can also be the biggest frauds. We're still looking for people willing to learn that lesson.